Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to dive into Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So we're just going to dive right in there and I'll share my opinions. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com is where I dive deeper into these subjects, topics, sectors, and looking for potential investment opportunities across the commodity space at this time. I do look at other sectors outside of commodities, and I just don't like the valuations on a lot of them. But when we do finally reach the end of the commodity bull market, which I think is a good chunk of years away, we will be looking at other opportunities at the bottom after the great financial crash, is what we'll call it. After that crash, we'll be looking at opportunities in technology, S&P 500 stocks and stuff like that in the future. So we've got Ron H. He says the hurricane Beryl, however you pronounce it, forecast path is a direct hit on the Corpus Christi LNG plant is what they've got at the moment. And obviously this is just a projection. But what is important here is a hurricane is approaching parts of Texas, and it could damage some liquefied natural gas plants or some of the oil fields, some of the producing oil fields in that certain area, natural gas, oil, and etc. We've got looking back at different time frames at this oil price versus oil producer share price relationship. There are periods of disconnects, but high correlation longer term. Below shows a 5-year chart here. And you can see there's some disconnects between the price of crude oil and the equities. What I am surprised here, and what I normally see, is I normally see an underperformance of the equities when oil price falls, and then I generally see an outperformance when equities go up against the commodity itself. And we aren't seeing that here with XOP and the 5-year average. They have the 5-year average being 44% for crude oil and 39% for XOP. There is a little bit of outperformance from I would say, well, not really. It's not, because from bottom to top, but this is also a negative number. That is kind of weird to have crude oil, a commodity, go negative. I wouldn't even think that would be possible. But either way, usually the commodity producers outperform the price of the commodity itself, the equities do, because the equities, you're basing the difference on their margins, and their margins can expand way quicker and faster than a commodity price. So that's what gives you the leverage, is because of the margins of the company, and they can swing negative to positive. It definitely would swing negative to positive if crude oil went negative. And I'm surprised I don't see that leverage there. Here's another one too that he talks about. He says, oil producers produce and sell oil. The recent divergence in price between the two is noteworthy. You can see this big price divergence between crude oil going up about 15% almost, and then we've got XOP down 1%. What is going on here? Is it people positioning for a potential recession? That very well could be the case. Maybe there is a recession coming, and that's what the market participants think. And maybe that's why it's underperforming crude oil. Maybe they don't believe in the crude oil move. I could make up a billion different scenarios of narratives to try to explain the price difference. But at this time, what we can say with certainty is that there's a divergence, and the equities are underperforming the commodity itself over this period. Bloomberg U.S. Financial Conditions Index hovering near its easiest, loosest since 1970 or 1997. So this is actually hovering around its loosest area in terms of financial conditions index. Loosest, really? Easiest, loosest? Well, that surprised me when I saw this chart here. that we are hovering almost all the way back into the early 90s, basically. Bulls keep ignoring the triple divergence on the monthly chart. When this gives a 300-point daily drop is coming. Fun starts next week. Until then, enjoy the last few days of this bull market coming to an end. In his opinion, 4,500 by end of July. And what he's looking at is we've got this big move upward in the S&P 500. It is a rising wedge, and rising wedges generally break to the downside. What he's noticing is this big divergence on the relative strength indicator. As we move up, our strength is declining, and we're right at this trend line. He is expecting that the trend line is going to be a resistance line, and we roll over, and the relative strength declines along with the price movement of the S&P 500. We don't know that for sure. We are looking for these divergences in the market. We are looking for rising wedges. I would say his case does look pretty strong for a potential rollover, is what I will say. Coming over, unemployed workers in the United States, June 2023 is just under 6 million. In June of 2024, it's about 6.8 million. The labor force in the United States, that also went up. In June of 23, it was 167 million. In June of 2024, it was 168,009,000. The unemployed workers divided by labor force equals the unemployment rate. So back then, in 2023, we had 3.6%, and today we have a 4.1%. The unemployment rate are those two rates. So are we going to get a recession? Is this data indicating that something really bad is going to occur? I don't know about that. But it does look like things are slowing down. That's definitely sure. Here's a couple of quotes, one from Warren Buffett. Valuation of a business is not reducible to any formula where you can actually put in the variables perfectly. And Seth says, any attempt to value businesses with precision will yield values that are precisely inaccurate. So you cannot precisely value a company. You can only get in the general ballpark. And then you try to put some sort of margin of safety by buying it when it's on sale, when the market is either in fear mode or it's out of favor. And the sentiment is bad towards that business or sector or whatever it is. So that's basically kind of the bare bones of, some of these guys, they think they can precisely do something. They just can't. We put in another cycle low on a year-over-year full-time job losses. The decline is 1.55 million over the last year. Now, here is something that I will say. It depends how you look at this chart. It really does. And when we look at it, we're down all the way down here. We've got a recession in 73, 75, Volcker recession here, Gulf War, dot-com recession. We've got the great financial crisis that went off the page there, and COVID. And we're down here. Now, the question is, well, we're already down here. So how much more do we have to the downside, or is the majority of the downside already out, behind us? If that's the case, then this would be a good time to be looking for potential buy points. And this is year-over-year change of full-time workers. So maybe the bulk of the slowdown's behind us. That's yet to be determined. That's just my opinion when I look at these charts. Every time you get down in this region down here, it'd be a great time to buy. And we're very similar to these regions down there in terms of how many number of full-time employed workers has fallen. It's now looking increasingly likely that we're approaching an inflection point for the labor market, and the Fed should sit up and take notice. And why am I talking so much about the labor market? That generally leads a recession, if you want to know. Key takeaways from the June employment situation report says the trend in private job growth cooled to below its pre-COVID pace with substantial negative revisions to prior months. The unemployment rate rose to its highest non-COVID level since the beginning of 2018, lifting the SOM rule to just 10 basis points below the recession trend line. Typical service sector wage growth slowed to below its pre-COVID average and showed no signs of stabilizing. So let's take a look at the data here. This is the unemployment rate. You can see this is continuing to go up. The 3-month average and 6-month average and the unemployment rate. Those generally are a precursor to a slowdown in the market. They really are. And let me make sure you guys can see that too. Monthly job growth, it's staying quite stable, and we're back to kind of pre-pandemic areas. The SOM rule, which is the 3-month average unemployment rate versus the trailing 12-month minimum of 3-month average, that's been increasing, and that generally is getting pretty close to a recession level area. The recession threshold is 0.5, and we're at 0.4 and increasing towards it. And then the median monthly growth in average hourly earnings by industry annualized has come back down to 2.9%, 3.3%, and 4.6%, depending on which industry you're looking at. Coming on back. Unemployed workers in the U.S., I already went over that one there. Natural gas production hits 102.4 billion cubic feet per day. Looks like we will be heading towards 103.5 billion cubic feet by the end of the month. So we've really ramped up our natural gas production here in the short term. So we, one, are able to ramp it quite quickly. That's one thing that we should gather from it. And two, we are producing more, and that might have an impact on how much we could potentially inject into inventories in the future. I think there's no single explanation left as to why energy sector continues to struggle and underperform, especially when oil is averaging $80 a barrel. Well, I can give it a shot. The ones that we just went over up here, all of these unemployment rates and the yield curve inversion and uninversion of the yield curve, that is what you can explain why oil might be weaker. More money is starting to maybe perhaps transfer into precious metals, in those sectors that are more defensive. Oil isn't, that's not a defensive sector. That is more of an inflation play, and maybe people are getting worried about a slowdown in the market, which will be disinflationary and or deflationary, depending on the outlook that people hold. Obviously, this is highly subjected to sentiment in the market, and that sentiment is what causes and drives money flows differently in the market. So perhaps, and I don't know if the market is right or wrong here. It's right, obviously, that the market's always right, but maybe their viewpoint is wrong of the reasons why, and maybe they come back into the oil sector, or maybe they're right, we get a slowdown for a period of time, and then afterwards money comes back into the market. Maybe, for oil, that is. Finance has 3 simple rules: maintain a clear mind, figure out asymmetries, and never talk to idiots. Says Nassim Taleb. So, clear mind, find out where those asymmetries are, and never talk to idiots. And I'll just talk about the asymmetries. I think there's a huge asymmetry. And given the market conditions that I'm starting to see, I think gold, silver, and platinum are looking pretty dang good. And the mining companies as well. Oil can still do well. But if we do get a slowdown in the market, that will definitely impact oil in a negative way. And we are seeing some divergences of the equities versus the underlying commodity itself here in the short term. So keep that in mind. I'm not going to sell anything, but I may allocate the portfolio of new money coming in or some of my dividends coming in to other areas to balance it out differently, perhaps. Yield percent versus oil. So to whom it may concern, one can clearly see the lag in yields versus oil. The 10-year lagging oil and 30 basis points, oil at 95 would suggest a 5% yield. This would be not good for the yield sensitive NASDAQ. So we could see the US 10-year potentially going up if oil breaks like we have and that continues higher. Now, the big question is, in the short term, is oil going to work its way on up and our yields going to follow? Number one. Or two, is the unemployment rate going to have a negative impact in some of these slowdowns in some of these other sectors in the United States, where we go into a slowdown in the United States and oil dips, pulls on back, which would also probably correlate very highly with a dip in yields. And that is the big question. I don't have the answer. I don't think anyone has that answer right now. And we're all watching yields. We're all watching gold and silver and oil. Is it possible that they all go up together? It is. It is possible they all go up together. And that, my guess, would be a declining dollar, because they're all priced in dollars. And that's generally when they all go up together, is when the dollar declines. Game over. According to Global Markets Investor, U.S. ISM Services PMI plummeted to 48.8 from 53.8. Lowest level since the COVID crisis. U.S. manufacturing contracted in the last 19 out of 20 months, the longest streak since the Great Financial Crisis. In the past, both industries contracting occurred only in recessions. So we've got another box here that we are contracting here. And then my thoughts, again, are similar to previous thoughts. Well, maybe the majority of that contraction is done, and maybe we will bottom soon. Or maybe there is still more left to go. A lot of people have tried to predict these recessions. It seems like a lot of them have gotten it wrong. They're not within a few months. They're usually not even within a few years of when this recession is going to come. Maybe we're already in it, and maybe it's being covered up by a bunch of money printing, and nominally we are papering over the recession, the slowdown. All things that could be taken into account, and all probably have valid points, and you could argue for any one of those. But right now we are slowing down, and it is in a location where we could see a slowdown in the market / recession. This is Ryan. He's talking about 10 baggers. He says, just how important is sales growth? For 10x stocks in the last 10 years, nearly half of the 1,000+% returns has been driven by sales growth. Margin growth and multiple expansion combined account for the other half. So we've got sales growth being a huge driver for 10x stocks. And then we've got multiple expansion and profit margin growth. So multiple expansion, what that means, let's just go over this real quick. So sales growth is just growing your sales. You've got fast sales growth. They grew their sales, and that accounted for the majority of 10x stocks, 47%. If you look at the 28%, profit margin growth is the company is taking that sales growth and they're becoming more profitable with it. So their margins are increasing with time as well. So you can have a profit margin growth on top of sales growth. They're becoming more profitable. Every dollar that comes in, they keep more of that dollar in profits with time. And then multiple expansion, that is your price to earnings. So you went from a very cheap price to a more expensive price for the stock. So let's say it started out with a PE ratio of 2 or 3, and then it went up to 8 or 9 or 10. So it was a combination for these 10x stocks of probably the majority of all of this. Commodity companies, they are subjected to the price of the commodity. That is the most important thing driving the returns of a commodity stock. If the commodity goes up massively, it will usually impact all three of these all at the same time simultaneously. Because they have usually it's not a totally fixed cost, but a lot of their costs remain relatively close to each other year over year. Maybe they go up 3% or something. But the commodity price could go up, a 2x in a very short period of time, or 50%. That's going to impact their sales. It's going to impact their profit margin, and it's going to impact most likely the way the market views the company, and you'll get multiple expansion. That is how commodity companies produce such large returns in short periods of time is because it impacts all of these simultaneously through the price of the commodity. Another thing that can drive commodity stocks through the roof, aka greater than 10x, is the denominator gets hit on the commodity. So the commodities are priced in dollars, and commodity prices go up when the US dollar falls. That's the denominator falling. So you could have a dollar weakness and commodity prices go up and impacts all of these areas positively for the company that you're invested in. That's how they're doing it. Bitcoin, it's like my bio says, a picture painted 1,000 words. Technical charts are not voodoo. And he's got a Bitcoin breakdown here, potentially, and that's that breakdown of the support line there, which has led to some selling pressure in the short term. Russell 2000, bear market begun in January of 2022. Scary. He's got the overlay here where we've got the bear trap coming there. We have big, huge run up. And maybe we're in the bull trap where we get a big move lower. We are seeing a lot of these people on Twitter trying to fit fractals over a lot of the NASDAQ, NVIDIA, Amazon. They're trying to fit it to the Russell 2000. Maybe they've got it, maybe they don't. One step further that I would do than just aligning a fractal and seeing how it fits is looking at the conditions that these are trading under. We are seeing unemployment go up. We are seeing a slowdown in the housing market, but we'd have to see a further deterioration in the housing market, I think, to lower levels to be sure that the housing market's going to slow down and potentially cause a crash. But unemployment rate is going up, and you could have a slowdown much like the NASDAQ 2000 bubble. We could be in a bubble. We don't know until it's behind us. So these charts will give us some indication that we are potentially rolling over. And if we do see that follow through of the rollover, we can definitely say, yeah, it's probably going to go lower and we're probably in a bubble. It's very difficult to know when you're in it where the exact top is. Very difficult. Not a lot of people can do that. But you can get close. You can get close within 6 months or something like that. Unemployment trend consistent with recession and should continue to rise, in his opinion, in terms of the labor market condition index worsening, I should say, and the USA unemployment rate following behind it. A couple of more quotes. If you can step back and take a longer time horizon, that is the big secret. That's exactly what I adopted in my view of all of this. I take a step back, I look at the longer term time horizons, and honestly, guys, this short term stuff, it is really hard to nail the short term. The bigger picture view, looking at the conditions, looking at how these things trade, looking at how people react to those market conditions, usually gives you a little bit better picture. It says if you want to invest the way people gamble at casinos, you're not going to do very well. It's the long-term investment that works the best. And again, that's what I've adopted. I've tried to adopt longer time frames as I got older, and I've made a lot more money doing that. The short term and trying to time a recession, trying to time all this stuff, I'll just say a lot of people don't get it right. Now, here's one thing that I will say. What if you sold trying to time a recession, but the recession didn't come, and the commodity bull market rips, and you missed out on some of the greatest opportunities in the market? How would that make you feel? And then you have to ask yourself, well, what if a recession does come and you're holding these stocks and you get a 30-40% correction? Well, how does that make you feel? And which one would you regret more? Selling and missing the commodity bull market, or having to ride through a 30, 40, 50% correction? That is what you're going to have to weigh. I would regret more missing out on the commodity bull market myself, and I would use the 30 or 40 or 50% correction in the stocks to accumulate more of those assets. But that's the way that I would manage it myself. Art Berman says, shame on that person on Twitter for posting a chart based on ignorance of physics and deceitful, infantile fantasy. Wind and solar are zero rounding error for global energy consumption. Fossil fuels have dominated global energy for 225 years. And this here says there's no energy transition or green revolution. Wind and solar are 2.4% of world energy consumption, a zero rounding error, in his opinion. Brandon said sometimes the funniest outcome is the most likely. That's why I'm going to leave this chart here. Imagine if gold outperforms Bitcoin over the next 3 to 5 years of this potential bottom where we could be breaking higher. What would cause that would be my question. It's the market conditions. We could see a slowing of the economy or a slowing of the stock market too. Combination of those two things. Unemployment rate goes up. That's generally when gold goes up. That is when the NASDAQ and potentially Bitcoin go down against gold. So there is a scenario, I think, where the NASDAQ and gold can go lower and gold can go higher. I just gave one example of a market condition that could occur under. Here's June jobs from Warren Pies. He says residential construction payrolls hit a new cycle high. We see potential slack ahead, but nothing officially troubling yet. Overall, the report paints a softening labor picture. Government, HC, and education equals 74% of the 206,000 jobs added. So he's not quite worried yet about a potential slowdown, in his opinion. Here's John Templeton. He says 99% of investors shouldn't try to get rich too quickly. It's too risky. Try to get rich slowly. And I don't think he means like try to get rich like literally slowly. What he means is don't take on too much risk to try to get rich quickly. And a lot of the times that people do that, they go broke because they take on too much risk or too much leverage and risk. Jesse Livermore is considered to be the most, I'll say the best trader in the world. But this guy, I mean, he got ultra rich very quickly, but he also went broke 3 or 4 times throughout his life, and he ended up dying broke. That is the most successful trader in the world. And really what he did is he just took massive gambles in the markets, and he won like 3 times or 4 times. He also lost every single time afterwards. So I think what John is talking about is if that is the best trader in the world, basically gambling, got right a couple of times and got wrong a couple of times, that's the best traders can do. Going rich and going broke. Most of these guys who make it a little bit more slowly, like Warren Buffett, Peter Lynch, some of these other guys, they kept all their money and they never go broke. They just keep getting richer and richer. So the strategies that are deployed are obviously much different than taking a high risk, high leverage bet and getting rich quickly and or bankrupting yourself multiple times throughout his trading career, at least Jesse Livermore. Electric power producers can't meet growing consumer demand and their desire for reliability and affordability with renewables. That's why we had to withdraw our interim goal. Some people think we were bad for doing that. I think we're just honest. And this is, we don't see a pathway to coal phase out, said the U.S. utility. And a lot of us have been talking about this on Twitter and some of us in the energy space. It's like, how are they going to meet their growth? Artificial intelligence, electric vehicles, whatever they want. How are they going to meet electricity growth without using a bunch of fossil fuels? And this is basically saying they can't. They have to keep using fossil fuels. Great investment opportunity. It ain't just the Fed. China liquidity is dull for now. This also impacts Bitcoin. And this is the 28-day rolling liquidity injections, and it's pretty low here in 2024. We've got some negative in China. Here's something that Grady said. This is the last thing I'll read here. It says, inflation backing down, question mark. He says gold has broken out and resumed its bull. Silver's broken out, resumed its bull. Oil bottomed for a 3-year cycle low. Agriculture have broken out hugely. Grains are bottoming. Central banks have entered a new rate cut cycle, causing scare. Metals and mining looking bullish. US M2 plus interest payments going parabolic. Prices are still elevated. Supply destruction has been enormous. Bottlenecks in labor supply. QE infinity is coming. Platinum and palladium are starting their bull runs. Natural gas bottoming big picture. Uranium in a bull run. Whole commodities sector is in a bull market since 4.5 years ago. Bitcoin still staying elevated after a huge run. Commodity ratio charts versus other asset classes are all looking fantastic. Consumer spending is still strong, etc., etc. So that's where I'm going to end it, guys. Give me a thumb up for the content, subscribe to the channel, and we'll catch you guys later. This is Finding Value.